Hey, thank you for coming, everyone. So I think for those of you who were with us last Thursday, we went over like the apartment investing 101, all the basics. So today's presentation is kind of built on that. We're gonna do case studies and go over so kind of like apply what we talked about last time to real life projects. So that's what we're gonna talk about today. All right, then here we go. So this is a small group. I know we don't have a lot of people here today, so please feel free to ask questions at any point. We want to make it interactive and fun. Here's the team. Like I said, Tiffany is celebrating her son's birthday today. So Noel and I are here. We will hold it down for you. I'll turn it over to Noel.
Great. So let's get started right now. We hit that next, that's the table contents. So the next one. Can everyone see the presentation? Lupe, I think I'm looking at you.
You are?
Yeah.
Is everybody looking at me? Oh my God, hold on, what happened? All right.
Well, I saw the presentation.
You saw the presentation?
No, yeah, I was able to see the presentation.
Okay,
Yes.
well, Lupe, go back then.
Okay.
Yes, did I.
How about that?
There you go. All right. Yes.
Yes.
Great. So we're going to go into some, before we dig in, we're going to go into some multifamily strategies. And as Lupe said, I just want to echo, we're going to give you some 3 case studies. These are actually real life case studies that we are involved in. So we like to keep it, I guess, as realistic as we can, using our own examples and kind of what we're seeing, what we experience. So I hope you enjoy. So we'll go ahead and go into some of the strategies. So right now there are 3 main strategies that GPs use when acquiring property, doing a deal. And some of those that we look at are stabilized properties, value add properties, and then also reposition properties. And what I'm going to do is start going into each one of those in a little bit more detail. So a stabilized property, and you see the picture right here, you have, the gym, the pool, that's shown in that picture. Normally stabilized properties normally are grouped by classes. So most of the popular stabilized properties are considered Class A properties. Class A properties are just another way to describe the neighborhood that that property or that building is in. You can also have a stabilized property in B areas, and sometimes in the C area if you're in like maybe a rural town. So your factors of what state and city also will play an account for a stabilized property. So buying a stabilized apartment building offers a lot of benefits that is immediately performing. Normally you have a good management team that is already in place, and you receive low cost financing, which really translates that you should immediately be receiving monthly income and profit right out the gate. So there's no waiting, no vested time. There's also other benefits is that there's an opportunity to lower operating costs. Normally, not so much. I think the real benefit of having a Class A and stabilized property that it's already kind of a turnkey property. So when you're buying it, it's really set and forget. It's it may be higher, but it's a low risk. During the COVID pandemic, Class A properties and these stabilized properties outperformed really any other investment asset that you would place it up against. Because normally the tenant base in here were able to actually work remotely, so they were still able to pay their rent. What else I want to talk about? The obstacle of a stabilized property is that there's little improvement and for the rents, And so the property value may retain over the years.
Okay, next.
So we have value add. So value add is one of our favorites. So buying a value add apartment building means that you plan to perform improvements to that building to increase the value by either aesthetic upgrades. That means you're making improvements inside or outside of your building, or you're increasing the rents, or you're finding different ways to create new revenue. I don't know how many people live in apartments right now or previously lived in apartments. I know I look back now, and when I was previously renting, and I remember getting like these increments every year. Now I understand why they were doing it. So I understand like the 3% increase every year. I also understand, the dog fees. I had an apartment that had me pay a flat rate for a dog fee. Then it changed in year 2, where they said now we had to have a monthly reoccurring $25 for our pet. $25 seems very minimal, but if you're in a 100 or a 200 unit complex, that really increases the value of your property. So so that's how you create additional revenue. And really the key to this is normally a long-term hold until you resell. So the goal of a value add is really in its post-renovation value. And therefore you really focus on improving the budget and the construction, because you'll have people knocking down your doors for the value adds. This is something that we really kind of as our niche. We look for value add properties. Sometimes we're looking at the value adds that are in B to C areas. So that means we have a C area, we're just going to do the capital improvements, and now we can make that into a B unit. Now, keep in mind what I'm saying about this C class and B class, because when we're getting to this reposition, there's some other details that sometimes we don't go into about how to really move a C class building to a B class. Because you can change rents and you can raise them, but also you have to work on the culture of the building. So when we have a new building or a new prospect, we'll look at the Yelp reviews, we'll talk to other PMs in the area, and we'll see what is that reputation of that building. So that is always important with the value add. Next to reposition. Oh, excuse me, I want to go back. Sorry, go back. I have a question. So you increase. So increase it due to the improvement they foresee. So yes. So normally we'll look at properties for a value add where they'll say, guess what? Rents are maybe $150 below market. Maybe the bathrooms have, that pink tile. You remember that pink tile? Whoever created that, you ever had those bathrooms? Like that was the style back then. So you always had that Pepto-Bismol design.
I actually love that. I love that. I want to go back to Three's Company and the Brady Bunch style of housing. I miss that. I love the exposed brick. I love the old, and then we can kind of make it modernized, but I loved it. You
might be the only person ever to say, I really like that Pepto-Bismol look there for the bathrooms.
But I'm weird, but yes, I love literally Three's Company is my favorite show. So,
another thing we want to look at for the value adds, most of these value adds are taking kind of a bridge debt. And sometimes that bridge debt, and what we're seeing even right now, we're seeing that a lot of folks took out bridge debt back in 2020 and 21, and they did not have a rate cap. So when interest rates went up, now people are underwater. So you will see a lot more properties if you're on brokers lists and things of that nature. You'll start seeing a lot more properties being offered right now, just because people simply just can't. The cost of money is just too much. So without that rate cap, they were not protected. And so now rents are extremely high for them. We actually have a great webinar. If you want to go back onto the website, where Julie Peterson, she's a broker for Old Capital Mortgage. She actually does a great job explaining the cap rate and the economics behind that, and why you'll see a lot more properties such as this coming on the market.
Thank you.
There's another question.
Okay. What defines the class for a property? That is a interesting thing. So normally you can define the class by really, it can be the ethnicity, it can be the employment, and also the salary. And so there are certain neighborhoods you would just define as, say, this is a class A, but it will vary from, you know, city and state.
So basically there are three, okay, so there are three classes, right? A,
Right.
B, C, and
You
anything
get D.
below that,
Yeah,
anything
four is D.
anything below that is called the war zone, right? And then
correct.
like some of you know, so I think it's just basically going from, it's like A is the best and B and C. Yep.
Based on those economic factors. And
Another thing I want to kind of touch on is like when it comes to the value add property, a lot of times you won't see immediate cash flow. It may be a period of time, it may be 6 months, 9 months, a year, until the property is like more stabilized. And a lot of times you will see a refinance, a cash out refinance is kind of part of the value add strategy, because once you increase the value of the property, you're able to pull the money out. Okay, so
and that's actually most people's strategy on even on A's. They'll let that equity build up as well, but it's more likely in the value adds, correct, and the repositions, which we're about to get into right now.
So I have a quick question about the stabilized. Is it because with value add, you're going to make improvements, and so there will be, you know, the value of the property improves because the improvements, and also operations are improved and rents are being increased. But with the stabilized, that is happening to a much lesser extent, or maybe just not happening at all, right? And so is it important to buy stabilized properties in locations which see appreciation, locations such as Los Angeles or New York City or San Francisco Bay Area, where there's natural property appreciation, as compared to a place like Dallas, which doesn't see that, or Cleveland, which barely sees any appreciation?
Yeah, correct.
Okay,
that's good, because it deals with the next one, because you can do value add and you can make all those improvements. And I'll speak to it more so in the repositions, but if you can't change the client base and actually get the renters that you want in there, you technically have not changed the class. You just made improvements, but you're still getting that same rental class in. With the question about Los Angeles, I think you go a little bit deeper, because then your search criteria goes into also, all right, this may be a stabilized product, but now also, what are the tenant landlord laws in that area? Are they stringent, or are they landlord friendly? Because now that plays into your purchasing strategy as well. But I agree with you, because I know that you are in Cleveland, and you see, like, you know, you'll have, I've seen them, I get them all the time. I'll see like 86 unit buildings coming across at $250,000. Well, yes, that's a great deal, but can you get the renters to fill that building, and can you get the correct renters that you want to fill that building? And that's the part
right.
a lot of people, when you do the value add or the repositions, we don't talk about enough. We always just look at like, oh, okay, great. We'll increase this this building. We'll make it look beautiful inside and out. But now How do you change the culture of a building? How do you get those certain, tenants in? So say if you want, will somebody feel safe walking in the dark in that neighborhood?
Hmm. Right. Okay, thank you.
That because you like those pink bathrooms. So repositions are normally heavy lifts. They can go from heavy lifts, or they can go from a reposition can also be on the lower scale of that, is that you are doing every unit. So every unit you have, you are turning over and changing over flooring, cabinets, appliances, towel, putting low flushing toilets in each unit. And so that is a reposition. So normally you have, again, high vacancies. The asset management has been terrible. And so I always say, like, with repositions, the only way to get more viable contracts, which are your tenants, and to get higher paying customers and residents, is changing the culture. The fact that a unit has been completely rehabbed and looks beautiful does not mean a new tenant base will be set to move in. So I always say repositioning an asset has two components. First, you must turn the units so that a new class of residents will want to move in, and you have to reposition the tenants base so that they begin receiving the larger valued contracts, which means you can raise those rents maybe $350. I would say the first part, as far as the aesthetic upgrades, are really easy. So if you have the rehab money and you have the CapEx, you can go to town. You'll have, like I said, contractors lining up to do your buildings. But the second part of repositioning is the hardest part, and in my opinion, and I think that's the one that a lot of the gurus never really talk about, is that repositioning will fail if you rehab every unit and then re-rent to the exact same clientele, or you keep the same exact asset management team or property management team that was in there previously. That wasn't a success, because now you just kind of created the cycle with just upgraded units. So, the success formula for repositioning is to succeed is that, you really must purchase a property that once rehab will be the type of place that has a higher level of clientele that will move in. Because remember, you can change the property that is within, the control, but you cannot change the neighborhood. And so some of these, as Lupe kind of, leaned on, is that some of these are really slow drips. Some of these you're not getting paid out for a year or 2 years while you're going to bring this property up and change this culture. So that's why you see, like, if you've driven by and like, oh, that's a new name, it used to be called this. They're changing the culture of that property in that building. They're painting it new. They want you to forget what you've seen previously 2 years ago. They want to change this property over. So it's now it's a new movement. And normally these products right here, these assets are done primarily with bridge loans and or cash. Some of your really, really heavy levy lift repositions that are like completely vacant, those are the ones that are, damn near impossible to find financing for. So you will need to have cash to buy these. There is a very, very high risk with this, but there is also a very high reward on this. So if you choose correctly, you can really level yourself out for a really big payday if you're holding this product maybe for 7 to 10 years, because sometimes that's the need for the change of that neighborhood. Yes and no goes to Saginaw. Okay. Saginaw, Michigan.
I know, keep on talking about Saginaw, but it's running through my mind now as you talk, because I'm like, that makes sense why he couldn't get anybody to rent this Airbnb for $25, because it has to be in the neighborhood that people in place someone goes to and they want to stay there, so that makes sense.
Yeah, because when you're picking a property, I know for Crown, we go into metrics as far as population growth over the last 10 years, the crime rate over the last 10 years, home median sales over the last 10 years. Who are the major employers in that area? Are they coming from another major city, or are they commuting in and out? We want to know those things because that is a predictability of what we're going to do with that building,
Oh,
and
wow.
if we're going to pursue that.
Very smart. I didn't even think about the fact that you even have to talk about the corporations and companies that are there, because they literally have one big corporation and it's Dow. That's it, Dow. And if you
Dow.
can't get to Dow, you have no job. So yeah, I probably wouldn't buy anything there. I get it.
And so, yeah, go ahead. So just kind of going back into this kind of recapping, whether you're in a class A, B, or C property, and your investment strategy for a stabilized product or a value add, and that value add becoming a stabilized product, you always want to do this, your due diligence. Again, we spend a lot of time looking at metrics within these cities that we invest in, because it doesn't necessarily have to be a primary market like a Los Angeles or a New York or a DC or Philadelphia. There are certainly secondary markets that perform just as well, and we'll get into some of those examples right now.
Can you see that, Noel?
The case study, yeah, this one is Country Club Apartments. So this is a new one that was purchased back in 2021. We're general partners in this one, 2021, I think March 2021.
Can I ask a quick question? So
Sure.
This is interesting, the time when this was bought. When you guys, when the pandemic started and everything went awry, did you guys actually think that the real estate market was going to go boom down, and then it ended up doing the opposite? Or you kind of could foresee that this is the type of thing that needs to happen for you guys to grow?
No, I think when you look at it historically, again, from real estate perspective, real estate has really performed outside of when we had like the 2008 crash. And that was just because in my opinion, again, I'm not a economist, but in my opinion, they were just giving, the banks were just too loose with the money and not verifying who they were lending to, which is a fault to them. But since they kind of have tightened up on their lending requirements, I really don't see that happening again. But again, I'm not an economist, but I do know as far as returns over, the pandemic, my real estate always performed for me. And I didn't get any, breaks, even with my tenant base getting memorandums and, things of that nature. I didn't have any problems. The same a-hole tenants that were in place before COVID were the same ones that weren't paying, during COVID, and you just couldn't do nothing with them, but just kind of wait that situation out. But as I mentioned in last week's meeting, if you compare real estate compared to the stock market over the last 15 years, real estate and multifamily particularly has outperformed the stock market threefold. Even now, when you look at the market and where we're at, I don't know if anybody's done any calculations about inflation or what your money is doing in the market. Because I do have money in the stock market and I'm getting killed.
Oh yeah, I haven't looked at it in the last 4 months because I don't want to cry.
Yeah. And I did some, I guess, I prepared because on this one, on one of our deals, where I invested $100,000. And when looking at that deal and comparing it to what the stock market had, the $100,000 in 19 months, I'm receiving, $141,000. But the same $100,000 that is in the stock market, and you can use this on the it's in Investopedia, and I always look at, you can select the stock, and I have it in a fund, but I do have Tesla stock and I have Amazon stock. So my $100,000 in Amazon would be worth $53,000 today if I bought $100,000, put $100,000 in Amazon 2 years ago. If I put $100,000 into Tesla 2 years ago, it would only be worth $105,000. If I put $100,000 into Apple 2 years ago, it would be worth $121,000. Now that's good, but now when you look at my returns from, or our returns from not only 19 months, that $100,000 is shooting out $140,000. So that's less time. It's a tangible object. So I can actually go to the property, feel the property, see the property. We get monthly updates with that property. You don't have to worry about, Elon Musk going on a rant, with Twitter. Now Tesla stock is tanking. So these are some of the things that that we want to make people aware. We're not here to tell you not to invest your money in the stock market, but we want to let you know that there is wealth without Wall Street, and there are other options there.
Love it.
Yeah, no, so agree so much. Even I was in stock market, and I've been absolutely brutally, massacred. And with stocks, even if hypothetically assume you got a great tip and you made 140 of the 100. With stocks, you have to now pay capital gains, which is never the case with real estate. And real estate, actually, you can depreciate. And in fact, whatever, your W-2 or income you have, it actually works against that and improves your savings for taxes.
Correct. Those are the benefits, particularly with syndications. That's the beauty of it. And like I said, we like to preach that, and that's our slogan: wealth without Wall Street. Again, we all have, we focus on multifamily, but we all have other investment avenues, but we just believe that multifamily is the best.
Right.
I'll say this is weird. I lived in New York City actually during the 2008, and I saw the mayhem and all these men getting fired from Lehman Brothers and stuff, and it's funny because at that stage in my life, I didn't care. I wasn't trying to buy property. I didn't care about my credit score. I was just living my life like Carrie Bradshaw. And and then now this pandemic and this, I'm like, now I get it. I get why people are freaking out and jumping off roofs and stuff. I get it now, because this is my time to this be important. So it's actually crazy, because I wasn't even bothered by 2008. I was like, what's this? I'm in my 20s. And then here we are. And I'm like, now I get it. Why grown-ups were so upset and my mom was so mean during that time.
Understood. All right. So let's dig into these case studies. We'll go into the first one, Country Club Apartments. Lupe?
Okay. Hey, so in this particular property, I am also invested as a limited partner, and we as a team, Crown Capital, is the general partner on this deal. So a little bit background: 134 units in Houston. The unit mix 1 and 2 bedrooms, mostly apartments, but there are some townhomes. And so in this case, the strategy is reposition, meaning it's a large project when it comes to upgrades and rehab. So as a result, as you can see here, right, there is no distribution for the first year. So a lot of times that is a good indication when you're going to a reposition property, or the property that's going through heavy upgrade. Little bit background. like Noel was saying earlier, here are some of the things we're looking at when selecting properties. Population growth, job growth, household income. Ultimately, you want to have people who have stable job that can pay rent, right? And there's a diverse economy. And of course, we all know Houston is a good place, very fast growing. So, one of the main thing, you'll see a lot of people like taxes. And the main reason is because it is a landlord friendly state, meaning that if you have non-paying tenants, issue with tenant, you're able to take legal action rather quickly, right? I think maybe everybody have heard some kind of California horror story, like you can't get rid of your tenant for a number of years.
Washington, sorry to cut you. Washington, D.C. is a renter state, and the people are like go crazy down here. They're just like they're squatting. So I understand what you're saying, and I'm like, I need to get back to D.C. I'm in Alexandria, and that's definitely a landlord friendly. I'm like, let me go back to D.C. because they protect you. I didn't know that was a thing that you guys made sure you looked into, but wow.
Yeah, it is definitely an important factor, because when you cannot evict people for a long period of time, I mean, you're losing money, right? Every month. So, yep. This is just the basic business plan going in. This is from the offering memorandum. Just give you a little bit more background on the price and the vintage, the breakdown of units. So for this particular property, we are on a 5-year plan. So as you can see, the first couple years, really, first 3 years is really to improve and stabilize. And then year 4 refinance, and year 5 exit. It is a pretty typical business plan for syndication. If you're seeing enough offering, and this is very standard. Let me know if there's any questions.
How much of the heavy lifting in terms of rehab is done in terms of like proportion? Like, are you guys like, are we halfway through, or?
I can actually take that one. We're actually about 70% through with this particular property. What happened is that there actually was a lot of economic vacancy, like physical vacancy there wasn't, but there wasn't a lot of people paying their rent. So there was actually a lot of evictions that occurred that we weren't intending on. So the business plan has actually moved a lot faster than anticipated.
So, but that also probably means that then the revenues coming in were lower because of all the evictions and the vacancies, right? Yeah. So that must have been a bit of a challenge financially speaking, right?
Definitely.
Yeah, right.
Financially, it has been, but it's good because this particular property is a bridge loan. Fortunately, we did buy caps on the bridge loan, but hopefully we'll be able to refi a little sooner than we expected. We actually have our lender as a partner on this particular property.
Thank you.
Oh, okay.
So this was considered a reposition because all the units are being renovated. So remember, if we go back to when we talked about the different classes, this one would be considered the reposition because every unit in this building is being done over. And remember, this is considered a B class building, but it is in a A class neighborhood. So we're going to turn those over, but then also with that and the rental increases, we also want to get that certain clientele within this building.
Are these projections per unit?
Yes.
I couldn't hear.
Okay, per unit, right?
Yes. So
okay.
We had actually projected 350 below market before we closed, but the average rent increases have been closer to $375, and that's per unit. And you'll notice the before and after pictures. So essentially, we're bringing this from a Class B to a Class A.
Mhm.
Okay, next.
Yeah, it's a fair amount of improvement on the outside also.
It is, and it's been
Yeah.
it's going very well. And we'd like to attribute that because Tiffany talked about it, and I spoke about it earlier about the importance of having a rate cap locked on there. So it saved us where a lot of other GPs are experiencing that grunt of higher interest rates, and now they can't cover their tab on their mortgages. And so that's good. It's a good thing. And then it's also strong property management team. So Kimbra is her name. She has a very strong team and a great history. So we always want to have those type of people on your team.
Right.
All right, and our next case study is the LaGrange Apartments. This is one in which I'm actually a limited partner on. This is 2 properties outside of Atlanta, around 70 miles outside of Atlanta, Mills Crossing and West Lake Crossing. There's a total of 94 units in this particular deal, and the mix of the units are 2 and 3 bedrooms. This is a 3 to 5 year hold with an 80-20 split and a pref of 8% with a cash on cash return of 9.5. The estimated return was a 2-time return. Next slide, please.
There's a question, Tiffany. Do you want to?
Oh, I'm
Okay.
sorry. Okay, so here's the question here. At year 5 or at the end of the business plan objective, if the investment is still doing well and is profitable, will you still exit? And if so, and if you do stay in, how much longer do you stay in? Will you already be checking for future investments for an investor to roll over? Yes. So here's the thing. If we're able to, once we are able to meet the business plan, typically we would go ahead and exit the deal to return everyone's capital so that they could actually redeploy it into another opportunity. So that's something that we do look at strategically doing. And yeah, there you go. Good question. And we're actually going to run into this one on this particular deal here. So as I mentioned, this deal is 70 miles southwest of Atlanta. And in this particular city, there's a great working population. Duracell batteries factory is down there. They have really easy access to Atlanta, even though it's 70 miles away. It's right on a highway. It's easy access to Atlanta as well as Montgomery, Alabama, and down to Columbus, Georgia there. Next slide. So these are the exterior conditions. As you can see, this is the Class C, working class communities, both of the communities. Next slide. These are the interior conditions. Once the remodel started, the particular GP team did not go high end for the tenant base. They didn't need to go high end with stainless steel appliances and high end fixtures. Next slide. And this was a value add opportunity. And I'll actually just kind of talk about what I just spoke about before. Whenever we are executing a business plan, we look at the class as well as the working population. I mean, we wouldn't want to over renovate units. And this is kind of an example where for the particular communities, we did not have to, well, the GPs did not have to actually upgrade to, stainless steel appliances and, redo things to a higher end. And so this is actually the hold. They're actually closing in 3 weeks on this particular investment. And this investment, I invested $100,000. And the hold was actually only for 19 months. And the return is 1.4 equity multiple. So from this particular opportunity, I'll make $40,000, which is around a 25% return over the 19-month period. And this is also kind of talking about the business plan as well. One thing that was done was billing back of the utilities. The expense ratio was actually 60%, and upon exit, it's around 40%. Next slide. And now over to case study 3, I'll hand it over to Lupe.
Okay, hi. So in this one, so you see this is a joint venture. So typically when you see a joint venture, it is a smaller project, and you can go in with your friends, family, you know, if you know what you're doing, and just kind of like pool resources, pool your time and money together. So for this particular deal, I have 5 partners. It is my first multifamily investment. It's a smaller property, 16 units at purchase, and then it also comes with a vacant lot. The reason why I mentioned that is because when you are in a place like Miami, right, or any big city or downtown, if you own a lot, it's actually like very valuable. So the lot itself was appraised for about $600,000. And the unit mix is smaller, so it's studios and 1 bedroom. And in this case, the previous owner, they are an elderly couple. They had the property for almost 30 years. It's like they are not really running a business. They're kind of like running a charity, you know. People were just there for many years. They're like friends and not paying, no any kind of bookkeeping or accounting. Usually those are the really, really good properties to do a value add, right? Because you know there's so much potential, there's so much rent growth there. So all right, and the original plan was to purchase, to one of the very first thing we had to do was actually send out the rent increase notice, or just send out the because everybody is on month to month, right? Nobody had lease. So basically you know, give people 30-day notice or 60-day notice to move, because we want to renovate these units. And also the units were not renovated, they're not in the best condition. So we want to renovate the units and increase the rent. Do a cash out refinance, and either hold or sell, depends on the market. So that was the original business plan. As you will see, it turned out very different. A little bit about location. It is in Miami, but it's not like the best part of Miami. You can see in the next picture, it is like more like a C neighborhood. It's a C-class building. But the location is good. I want to show this map here. It is very close to University of Miami Medical School, and they have a big medical center there. So here's the building, nothing impressive, okay? 2 little buildings, they're not pretty ugly. But you know, when you look for value add, you're gonna realize the uglier, the better, because then you can make it pretty. So the basic plan is, when we purchased this, originally it was a 16 units. There are additional space. It was used for warehouse, so we turned it into another additional units. So add the units, increase the rent. Basically, you know, bought it for 2.1, and so when it's not sold, it's currently under contract. On the contract for 3.5 in about 2 years. 2 years. Here's some pictures about the exterior renovation we did. So it looks a lot fresher than before and bright. And here is the, I want to show you some numbers because it's very interesting. So if you look at it, right, in month one, people are renting $300. $300 is, that was like maybe a rent in the 1990s, or I don't know. Miami at the time, the market rent is about 1,000, right? So this is like between 300 and 600. So if you look at kind of like the projection here, right, in month 12, what we are targeting, and you see how much the rent growth is. And then if you look at the monthly total and the annual total, and you see how much revenue increase just simply by you know, moving the tenants out one by one and renovating the units one by one. So it's a very simple business plan, and that's what we did. And there's a slide later on, and then we'll show you why this is a very powerful thing by looking at these numbers here and how that translates to the value of the building. And here are my numbers. I did $50,000 in this project. The whole time is gonna be maybe about 30 months by the time we close, because right now we're under contract. It's still not closed yet. We anticipate, you know, a few more months before closing. So there's been zero cash flow. We have not had any distribution because what we did was for all the income is being put back to the building for renovation. So so there has been zero distribution. This is completely equity play, right? You get your money at the end at exit. So essentially close, almost doubled my initial investment in about 30 months.
Great. So we want to talk about why is cap rate important? So cap rate, you know, the formula for cap rate is your net operating income divided by your value will give you your cap rate. And you know, all you guys know math is constant. You can work it backwards and forward. So value equals net operating income divided by cap rate. So in this case here, increasing the overall rents increase your net operating income. And with that, in the areas of the cap rate, now we have created a value add opportunity and really increase that value of that building. So we have right now, we have a cap percent. If you have your calculator, just pull them out or use your phone, or use your computer. You know, I love the quiz time. So if your cap rate is 5% and your net operating income is 50,000, what is the value of the building? Sydney, I'll get right to your question right after this.
$1 million?
Correct. Like can everybody put their answers in the chat if you finish your math? There are two questions, okay? So the part 1 and part 2.
There you go. And so if the cap rate now is 5%, and now we increase your net operating income to $60,000, and maybe this $60,000, remember we talked about value add before and how we can get increases. Maybe we placed in there additional pet fees. Remember I said you can add like $25 a unit, things of that nature. Those things add up. So now that net operating income is $60,000, what is the value of that building? I see Erica, you already placed it in there. Ash, I see it as well. Great. That's right. $1.2 million. So with that, you increase your value of your building by over, well, actually $200,000, not even over, but $200,000. I'm lost. I'm not a math girl. I'm an arts girl. So let's go right back down to your calculator, Star. You're about to be one of my favorites here. So here we are. So if you place in your calculator, 5%, you can place in your calculator 5% at 0.05, but that's 5% when you have that calculation, and the value is 50,000. So you divide 50,000 by 0.5, and that's where you get your $1 million. And Star, I'm gonna get on you right there. See, you like those pink, those Pepto-Bismol bathrooms right there. So we would have to probably subtract some money for you. Tiffany, you weren't here earlier. Star has a thing for the old Pepto-Bismol pink tile bathrooms, which is, I told her she's probably the only person I know that still really enjoy those.
Upgrade it, you pink tiles. I'm gonna tell you, Noel, I'm telling you, I just did what you said and I got a penny. That was my, I got a penny, not $1 million. So I don't know what you guys. I got a penny.
Great.
So I have a quick question, Noel, on this.
Go ahead.
So oftentimes, I've also heard that, and I wanted to understand when this happens, that, when you buy the property, the cap rate is lower than when you sell it, right? And when can such a thing happen? And so that if the cap rate increases when you sell it, then it's working against you, right? I mean, so that's a danger. So when does this happen?
So unfortunately, right there, we looked at, I guess it's part of the risk management and underwriting. When we look at each year, you mark it down by 50 basis points for your cap rate per year that you're holding the building. So those are pro forma numbers, but you try to counter that by always staying abreast with your mortgage brokers that are in the area and kind of keeping a pulse of what's going on in your marketplace. So I understand what you're saying. Unfortunately, there is no guarantee. You can kind of look at the trends of the market that you are in based on the original metrics of why we are purchasing a building there. So that will, offset and kind of keep you at a good risk management.
Mm-hmm. But like is there, can we pinpoint, this is, if unemployment increases, then cap rate goes down? Is there like a one trigger or like a couple of triggers that cause that to happen?
There are a couple of economic triggers, but sometimes they can be, according to like the Fed, that's a big trigger right now. So the Fed doing a rate hike, that's a big trigger. But then also, what if, I don't know, a major corporation that was, we'll for California, Toyota left California and moved to Dallas. So it had an adverse effect for California, but look what it did to Dallas, Texas. And then the migration from everybody from California to Dallas, Texas. So in that, so it had a negative, but also a positive impact in one city to another.
Thank you.
The point of this exercise, right, is because we want to show you why commercial real estate is such a powerful investment. And last week we talked about how residential is valued based on comps, right, the next door house value. But if you are able to control your income, basically you're able to control the value of your building. So this is why real estate is very powerful, especially in commercial real estate. And of course there are market condition, cap rate change, but but the point is like how this math works and how you can really manipulate the numbers by doing certain activities to increase the value of the building. And that's why we like multifamily.
Yeah, I mean, this is amazing, the returns that these three projects have given in so little time, and especially coinciding at the same time when the stock market has taken a brutal beating over the last 13-14 months.
Because if you think about it, if I want to increase the income by $5,000 or $10,000 a year from a building, it's probably not that hard, right? You bump the rent $100 per unit, like you're there, but you get 100 times in return. So yeah, that's
Right,
the big,
right.
oh, Erica has a question.
Do you want me to take this one?
Yeah, that's
Okay.
respond to.
So what drives the correlation between interest rates and cap rates? So essentially, it's almost like residential real estate. When interest rates rise, the prices of commercial real estate also begins to drop, and in turn, the cap rate drops as well.
We also like mention it's, yes, and city to city as well.
Definitely, it's city to city. And that's why you also want to
yeah,
make
too.
sure in terms of investments that you do invest in a city that has a very strong economy and also a strong population. Those things will help to pretty mitigate this risk. Your cap rate may still go up. However, it won't, take a crazy dip. There's also certain cities where it always remains about the same. Like it doesn't really matter if the interest rates do go up. The cap rates are pretty much always the same. And that's something that you always have to look at as well. I mean, I look at Baltimore, and that's one of those cities where the cap rate just always remains around the same.
We have an earlier question from Sydney that we skipped.
Oh,
That
I'm
was
sorry.
about contractor. Noel, do you want to answer that? How do you find contractors you can rely on to do renovations?
So normally for multifamily is different from small residential. So for multifamily, you always are looking for the property management company. It's really crucial who you pick and see if they have an in-house crew, or do they have reputable subs that they can bring in, and then also bringing in a rehab schedule or a scope of work. So normally within a multifamily, what you want to do is that you will always look at your rent roll. So you will turn over buildings according to when leases are up. So it's important that we prefer that our property managers actually have in-house teams. So that way you don't have to wait for them to kind of go out and find, or maybe that other contractor is on another job. They're already in-house, so they can immediately turn that unit over, and we can get it on the market.
Oh, so your property management company basically does the renovations for you.
Yeah, so that's the other key half of after you do a value add is really the asset management is key. A key to the success of that building, because the asset management of that is making sure that if you have any vacancies, those are getting filled. If there are any delinquencies, those are getting paid. If there were any previous evictions, you're getting them out there. If you have a turnover of building, the cost of turnover of building, any of the appliances, all that is scoped out beforehand, but you need to make sure that it's running to schedule.
And that's another reason why we do like multifamily as well, because we don't have to look for outside contractors. We look for property managers who actually can satisfy the needs that we have for the particular property and have a proven track record. There's actually another question here from Sydney. Do you think that the single family housing market cycle is completely different from the multifamily market cycle, in which case an investor could 1031 exchange into each asset class depending on the cycle of each? So do you think that, okay, so they are different?
What I mean by that is whether they are like their peaks and their troughs do not coincide. They're just operating on a completely different cycle. In which case, if the single family market is taking a beating, but at the same time, the multifamily market is at a peak, you can make your changes here and there depending on where they are. That's what I mean by that question.
Definitely. Understood. So on the multifamily side, the prices have also dipped as they have on the single family side. However, in terms of the demand has not dipped. So that's where you're going to find the biggest separation from the two. for example, right now, it's harder for people to actually afford to buy new homes and homes overall because of the interest rates going up. So the demand for apartments have actually increased. It's harder for people to build new homes now because it's so much more expensive and the interest rates are going up. So again, the demand for apartments continue to grow. And of course, we do have a housing shortage overall. So they actually don't, coincide with one another.
And the 1031 question.
So you could 1031, of course, from the single family side to the apartment side, but go in the opposite direction would not be an option. Does that answer your question, Sydney?
Yes. Why wouldn't it be an option? They don't allow you to 1031 from a bigger value to multiple smaller values. Is that an option?
No, it's not an option. 1031, you have to go up in value. So you're going into something bigger.
That's good to know. Thank you.
And we're actually going to have a 1031 expert on one of our series as well. And she's actually going to go into all the do's and don'ts of 1031 exchanges and what's allowed and what's not. But that'll be coming up in the next month and a half. And then
question is, so how do you offset the unpredictable impacts 2 to 3 months? So when you purchase a building, we'll speak about one that we have right now. We're general partners in a portfolio called the Waterways portfolio. It's 92 units in Lubbock, Texas, and 64 units in Louisville, Kentucky. These buildings were really purchased within the last 2 to 3 months. And so when you have these buildings, we meet with the property management team weekly, going over if there are any delinquencies, onboarding any vacant units and turning them over to increase rents. I will actually be out in Lubbock, Texas for the week of the 23rd, spending a week out there at Canyon Apartments in Lubbock, Texas, meeting with the property managers and such, and walking the building. So you wouldn't let it get to 2 to 3 months. That's why the asset management team is very critical to the success of your business plan.
Gotcha. Go ahead.
Oh, I'm sorry. Also, below 40% occupancy, you won't be able to get agency lending, or it'll be hard to get any sort of lending when the building is below a 40% occupancy. So, I mean, that's another thing, because the banks have to underwrite the property as well. And when we are going through due diligence, like, we are pulling the bank statements and the tax returns of the seller. So if they say that the net operating income was $100,000 and it doesn't match up, the rent rolls and the actual leases along with the bank accounts and the tax statements don't all align. It looks like we lost the presentation there. If they don't align, then, I mean, that's a telltale sign that it may be something we want to walk away from. But in terms of something getting below 40%, that's not really something we see on the multifamily side, to be honest with you.
Yeah, I suspected it might not happen, but it's like, because you mentioned earlier about the increasing cost of housing, right? And how it drives, people are driving towards, all right, so it's a prediction for driving people towards renting more so than anything. But the likelihood is also that as the increase of housing is going up, we're also seeing an increase, as you mentioned, for improving the production of the home itself, or the renting itself. You guys are increasing the rent, which inadvertently creates a new stifle for people to actually look at renting themselves independently or going in as a group. So what you end up seeing is more, because they had an article out, and I only bring this up because of this article that I read, where they were talking about how people are returning back home from 2 generations ago, 2 generations that have actually been going back, returning home versus renting on their own because of the increase of rent. So it's like, yes, you are able to increase the value of the property, but are you truly meeting all the occupancy requirements later down the road where you're getting that 80-90% that you guys are looking for or more? Because I guess, and I'm not getting it all out correctly. I mean, it's weird because I just know right now the market is also pointing towards most property management firms that have negative reviews. Oh, got you. Actually, yeah, this question runs in line with my thought, the one about most property management firms. But I guess the point that I'm getting at is like, how can you be certain that the project itself, you're saying that you're looking at the historical value, but is the historical value actually a direct reflection of the future for what should be? I guess is what I'm getting at.
So we don't look at just the historical value. We look at the entire macro and microeconomics. So we look at the location of the property. We look at the population. We look at the median household income. We look at, I mean, everything as a whole. So, I mean, that's how we mitigate a property going to 40% occupancy. So there's a lot of things that go into it. And I mean, I've seen articles like that as well, but I mean, 40% would be like a 5-unit building or a 10-unit building, maybe. And also it's like, you have to look at the different cities and the populations, and you look at median household incomes, like I said, but we also look at job growth. That's one of our big things that we look at. And we look at just income growth in that particular area too. We wouldn't put a business plan together that said we would increase rents to a point that the median household income could not afford it. I mean, we look at those things to ensure that they align. I mean, that's very risky if we say we can increase the rents to a point where the people that live there wouldn't even be able to afford it. Does that make sense?
It does.
Right.
Yeah. I mean, we look for strong economies. We wouldn't look for a weaker economy and an economy that's poorly populated.
Yeah, such as example, sorry, Ash, like Cleveland right now. We'll do that one there,
What
buddy.
you were gonna say. All right. And Sydney actually has another question. Most property management firms have very negative reviews and horror stories, such as on Bigger Pockets. How do you do your research on PM firm and find good ones that could manage your assets well and handle turnovers of the units well? I'll let Noel, you want to take that one?
Yeah, I will. So I think there's probably a big difference on some of the smaller property management firms that maybe Bigger Pockets are speaking of, but I do know you select your property management team way before the deal is closed. So we're already reviewing their practices, their methodologies, such as what are their practices of evicting somebody. You know, give us that step-by-step, like, what are you doing here? We're also looking for them to give us other GPs or other investors that they are representing them. We want to see what their experiences are. So you're right, there are rotten apples everywhere, but that's on your GP to do the due diligence to ensure that we are securing the most efficient and qualified property manager.
And where do you get that information independent, in addition to?
Yeah, that's when you
referrals.
just, so when you're in the market with the market that you're in, whatever area, that's part of your market research to see who is in that area and what type of buildings are they representing.
And Sydney, sometimes we already have property managers before we even have the property because we've already built the relationship with them. And we already know what they can do. So if we are looking at certain properties, we may call the property manager, and the property manager, many times, if they're a good property manager, they'll end up having like the background on the property and be able to give you the ins and outs and tell you, yes, the rents do align. These are our projections. They do align. These are our expenses. Like, they will review all of our expenses and our projections that we have underwritten, and they will actually validate them. When it's time to go through due diligence, they walk every single unit with you. They have their contractor team there. So it's something where it's a lot different on the multifamily side versus smaller multis and the single family side, because the level of sophistication is a lot different.
And there's also ones that, you know, which is sometimes a telltale sign is that you can, interview a property management and say, hey, we don't service that side of town. We won't service that building. And so sometimes that's like play like, oh, what type of property am I getting into where they don't want to, they'll know they'll get paid, but they don't want nothing to do with it.
I have a random overarching question, if you don't mind.
Sure, go ahead.
Okay, so I'm just getting down to the nitty-gritty of it. When do you see your profit after your buy, after the construction is done, or after you sell it 3 years later? When is the money coming in? Like, are there different times or one chunk?
Who wants to take it?
I can take it. So it all depends also on, we just went over 3 different GP, LP, and JV. So if you're a GP, you actually get an acquisition fee. So when the property closes, you get an acquisition fee for pulling the deal together. If you're an LP, you get cash flow throughout the deal, but you get your bulk of the money when there's a refi or there's a sale. If you are in a joint venture, typically you're going to get cash flow, and then you'll get the bulk of your money at sale as well. In Lupe's case, there was no cash flow, but we also have a deal where when we refinance, we're going to have infinite cash flow because we were able to get really good terms on that particular deal. But typically from an LP's perspective, you will cash flow throughout the entire life cycle of the deal, but you'll get your like big bang either at both refi and the sale.
Thank you.
And also that's all laid out to you when you invest in what it's called a PPM, private placement memorandum. So all that will be outlined, all the things that Tiffany spoke on, talk about acquisition fees, distributions. So there won't be any type of unpredictability or surprises to you. Any additional questions? Open platform, any additional questions before we wrap up?
If no one else does, I do have, but I'll let others go.
I have a quick question. Do we upload these recordings onto the Crown Capital website? Is that what we do, or?
Yes.
Okay.
All of the recordings are on the Crown Capital website, and we also email them out to you.
Okay.
So the email will go out tomorrow at noon.
Thank you.
Sydney?
Yes.
Yeah,
thank you. I was actually doing some math on real estate investment returns, and it seems like in order to get enough cash flows, even to hit financial independence, where working is now optional, and then beyond that, in order to hit those cash flows, a lot of money has to be invested. In the best case scenario, you're looking at the minimum of $1 million in cash invested, say turn that into $3 million in assets. And others have suggested something like $2 million just to hit the cash flow where you don't have to work anymore if you don't want to. Then going beyond that requires a lot more. And it seems that it takes a lot more time. So I guess my question is, how do you guys look at that situation? Am I missing something in the math? And secondly, what are the peripheral opportunities from real estate above and beyond the cash flow?
Yeah, I would say one, I don't want to dive too deep, but we can always meet offline, even tomorrow. But let's address your questions here. So when you're saying that it's taking a longer amount of time, I would say, are you a W-2 employer right now?
Yes.
Okay. How much do you contribute? Or I don't want to get into your salary. Give me a range.
How much do I contribute to what?
Your income range for your salary.
6 figures.
Okay. And are you doing a company match?
Yes. For retirement accounts?
Yeah, your 401k.
Yes.
And so is that 6 or 7%?
Not even close. 4%.
Not even close. So I would, without going into too much detail, and we can meet offline, I would take that calculation of what you're paying on your 6 figures per that year for retirement and how long it would take you to, let's just say accumulate maybe $45,000 or $50,000. We'll keep it a round number. And what I'm saying is that I guarantee you that $50,000 to accumulate would be triple the time that you would have to take for if you placed it in multifamily.
I agree.
So when you say that it's taking a lot longer time, I would say everybody's situation and what they can contribute and place into a deal. But I would say look at your own contributions right now, or have you looked at how your 401k is performing right now?
Right. And no, I totally agree. I didn't mean to be negative with that.
No, it's not negative, but I'd like to answer that. So please don't take
what I meant with that was, real estate is a long-term play. And then in that long term, what other peripheral opportunities have you seen that real estate investing brings above and beyond the actual cash flow and appreciation and all that good stuff?
Oh, I can take that from my own perspective. So I started investing right after the Great Recession, and I took me 6.5 years to finally walk away from my W-2 job as a scientist, where I said, okay, I have actually replicated and exceeded what the company was paying me, and now I can go ahead and invest freely. Well, I wouldn't say freely, still strategically, but now I do not need my W-2. So I would say every situation is different, but you really have to work on your numbers. So and then forgive me if I'm getting the question wrong. I'm getting that. What do you need to retire from your W-2 to just live off your real estate?
Yes,
correct. So I would say that you should get very granular in your numbers. That's what I did. Actually, I'm in my office, so I have this book I can show you. I actually got it from Tony Robbins right here, the Unshakable book. And he from that book, reading that is that actually get so granular in your numbers that you know how many vacations you want to take per year, where you want to take on those vacations per year, what type of vehicle you want to drive. If you have a wife or you have like 2 or 3 girlfriends, what do you want to do for them? You want to get so granular that you know your number. And so you're working towards that number. And that's how you can retire from your W-2 comfortably.
Also, to add to that, Sydney, we actually have a session planned. I think it's like end of February. We have a person that we know who is living off his passive investment. So we are actually bringing him on as a guest speaker to share his experience. So if you're getting our newsletter, please be on the lookout, because we'll be sending that out. So that will be a session I imagine you'll be very interested in.
Yep.
Definitely. And I mean, he's strictly an LP, and he decided that he was a government employee, and he decided he wasn't going to go back to work after COVID, and he figured it out. Like, he worked his numbers backwards, and he lives off of syndications 100%. So I think that will be a really good session for you to tune into. I know personally, I mean, I diversify a little bit to hit my number, doing some joint ventures and some syndications. And if you have a really big sum of money, you should think about if building a relationship with, general partners and saying, hey, I have $500, $1 million. Is there any way that I can maybe come into this deal and maybe bring a little more capital for some friends or something like that, and see if you can get a little percentage of like GP stake as well as LP stake. I think that just kind of really, like Noelle said, honing in on the numbers, and then also seeing like if you can kind of combine a few different methods. I mean, the GP, the LP, and the JV. I don't know how much time you have, but I just find on the multifamily side, even if you are in a JV deal, you're not taking as much time as you would take out on a single family. And I mean, I'll even ask Lupe, how many times have you gone down to Miami?
Exactly. Without drinking, Lupe, without drinking. That's what we're saying.
No,
Sometimes you go to Miami to see your property.
She's never been down there, and that's my point. So I mean, you can actually, even as a, full-time W-2, you have these options as well.
And, I mean, just something to complement what you folks said, I mean, I have been investing in the stock market, and it's been brutal for me of late. What I made over the last 4-5 years has all really gone down because the last 13-14 months have been so brutal. But in general, the magic of compounding, it really holds. And the return that real estate investment gives you is phenomenal. I mean, as compared to the stock market in general. And Noel already mentioned that in the last session as well as today. But just if you just run the numbers, and I just did, if you invest $100,000 and if you get a 12% return in 10 years, that $100,000 becomes $300,000. But then you keep getting 12% returns on that $300,000, it becomes 20 million in the next 10 years. Mm-hmm. I'm sorry, it becomes 1 million in the next 10 years. So it takes 10 years for $100,000 to become $300,000. But for $300,000 to become 1 million, it takes just 10 years. That's the magic of compounding. I guess all of us need to be a little bit patient, but the kind of returns that, Noel pointed out that real estate gives, it's just not available in the stock market.
Exactly, Ash. And again, we always say, we like to reiterate the wealth without Wall Street, because we just really want to give you tools of other options. We are, previous W-2 workers just like you. And we were, investing in real estate while working, 8-10 hours, dealing with our families, children, husbands, wives. We know what it's like. We've been there, so we all we want to do is make sure we're just showing you how did we do that? And, and give you those same tools and give you that same opportunity.
Yeah, and my LP investment is a prime example of making a 25% return in 19 months on that 100K. So,
right.
Yeah.
How did you all meet then? If you were busy working, how did you meet your investment partners? I just want to get some ideas for myself too. Who knows?
So we actually joined a coaching program, Noel and I, and then through that same program, I ended up from a friend of a friend in the program meeting Lupe, and Lupe and I actually run a women's real estate meetup together as well. So, I mean, we're in masterminds together as partners. I mean, we're in other masterminds as individuals. So, I mean, this is something that we really love and enjoy. Like even tonight, I have another, real estate related meeting, but we are all in on this. And so because we're all in, we're in coaching and masterminds and just constantly honing in on our craft. And that's how we met.
Ladies keep me on my toes. They are the sharpest of the sharp.
We actually have another question here. What cash flow assumptions are you using that is needed?
I think that was Erica asked. Is that a separate question, or is that with Sydney's? I was asking him. She was asking Sydney.
Oh, okay, understood. Thanks, Erica. Are there any other questions? All right, doesn't look like it. Well, thank you so much for joining tonight. Great questions. Next week, we'll be at the same place, same time, different topic. So we hope to see you there. We'll be sending out the recording tomorrow, and be on the lookout for next week's invite. Thank you so much, Noel, Lupe.
Thank you, everybody. Great discussion.
Thank you, everybody. Thank you. Very nice discussion. Thank you. Very helpful. Thank you.
Thursdays is a long week. We know you work, and we appreciate you being here. This is the first step on your journey. I like to look at this quote I have here, and it says, "It is in your moments of decision that your destiny is shaped." So I want you guys to just think about that and hone that in. It is
That
in
is
your
a true statement
of decisions that your destiny is shaped. I have recently been kind of revisiting some of the books I've read previously. One is Atomic Habits, and I'm always on now that 1% better every day. sometimes we get, life gets to us. It's been a rough day and week for all of us. And so, you try to be 1% every day. So we really appreciate you guys here and, on your real estate journey or multifamily journey.
Thank
Thank
you.
Thank you. Thank you so
Have
much.
a good night.
Very
See
helpful.
you next week. Bye.
See you. Have a good evening, everybody.
Thank you. You as
Bye.
well.